Okay, let's just dive right in. Today we're doing a really granular, technical deconstruction of one of the most complex areas in all of dependency law, and that's the qualifying relative test, specifically under Internal Revenue Code Section 152D. We're going to zero in on that high-stakes scenario where the person you're trying to claim is getting Social Security or SSI benefits. This is where the math and the law really collide.
So, here's our game plan. We're going to break this down methodically into 6 key parts. We'll start with the big picture, the foundational framework. Then we'll walk through the 4 essential legal tests. After that, we'll do a deep dive into the critical support calculation. We'll also distinguish between those different government benefits, cover the practical mechanics of how you actually prove your case, and then we'll wrap it all up with an actionable checklist. So why does this matter so much? I mean, why get this deep in the weeds? Well, because dependency status is basically the gateway to some pretty significant tax benefits. We're talking head of household filing status, various tax credits, you name it. And the entire architecture for all of this is built on one thing, Internal Revenue Code Section 152. That's going to be our foundational text for this whole analysis. Now, Section 152 gives us 2 different paths to claim a dependent. First, you've got the qualifying child test. It's, pretty straightforward. It's mostly about age and where the child lives. But our focus today, the qualifying relative test under Section 152D, well, that's a whole different beast. It is fundamentally an economic test. It demands a strict, almost forensic, mathematical accounting of who paid for what. Okay, so how does this thing actually work? Well, Section 152D is built on what you can think of as 4 statutory pillars. And to claim someone as a qualifying relative, you have to satisfy all 4 of these conditions at the same time. You fail on one, the whole thing comes crashing down. So, pillar number 1 is the relationship test. The law, specifically Section 152D2, gives you a whole list of family ties. Parents, grandparents, siblings, aunts, uncles, even in-laws. But what if that direct family link isn't there? Well, there's a backup plan under Section 152D2H. The person can still qualify if they live with you all year as a member of your household. Pillar 2 is the gross income test, and this one's a hard and fast rule. The potential dependent's gross income for the year has to be less than the personal exemption amount. For 2024, that number is exactly $5,050. But here's the absolutely crucial point. Gross income in this context means taxable income. That means tax-exempt benefits like Supplemental Security Income, or SSI, they are not included in this specific calculation. And now we come to Pillar 3, the support test. Honestly, this is the main event. This is where most of these cases are either won or lost. Unlike the other tests, this one isn't a simple yes or no. It requires a rigorous, detailed calculation to prove that you, the taxpayer, provided more than 50% of that person's total support for the entire year from all sources. It's a true financial battlefield. And finally, Pillar 4. This one's a simple but really important tiebreaker rule. The person you're trying to claim as a qualifying relative can't be the qualifying child of anyone else. This rule basically establishes a clear hierarchy in the tax code. It says the qualifying child rules always take precedence over the qualifying relative rules. Okay, let's get into the nitty-gritty of that 3rd pillar. The support test at its heart is pure math. It's what we call a numerator over denominator rule. And here it is. This formula distills the entire challenge down to one line. Your financial contribution, that's the numerator, has to be more than 50% of the total cost of support from all sources. That's the denominator. It looks simple, right? But the complexity, the real trip, is figuring out what exactly goes into that denominator. Right, so according to the Treasury regulations, total support is a really broad category. It includes all the obvious stuff, right? Food, shelter, clothing. But it also includes medical care, education, even recreation. But here's the kicker, the part that trips so many people up. Remember how we excluded SSI from the gross income test? Well, for the total support calculation, we absolutely have to include tax-exempt income like Social Security benefits. That denominator needs to capture every single dollar spent on that person's livelihood. This brings us to a really pivotal distinction that both the IRS and the tax court make. Not all government benefits are created equal in this calculation. You have to understand the fundamental difference between social insurance and social welfare. And this slide lays it out perfectly. On one side, you have OASDI, what we all just call Social Security. It's an insurance model, right? It's based on what a worker paid in.
So the law treats those payments as the person supporting themselves. But on the other side, you've got SSI, which is a welfare model funded by general tax revenues. And the law treats those payments as support provided by a third party, in this case, the government. Both amounts go into the denominator, but who gets credit for them is critically different. So where does this idea come from? Well, the legal basis for this whole distinction was really cemented in a landmark case called Lutter v. Commissioner. The tax court ruled that welfare payments, which were the precursor to today's SSI program, are support from the state, not support from the person who gets the check, and that precedent directly shapes how we have to do the math today. So, okay, we've got the theory down, but how do we actually prove all this stuff? We have to shift from legal theory to the practical mechanics of documenting everything. And that means tracing funds and figuring out how to value non-cash items correctly. This leads us to what might be the single most important operational rule in this whole process, the funds actually spent rule. It comes from a revenue ruling, and it's basically a doctrine of tracing. It doesn't matter how much money a person receives in benefits. What matters is how much of that money they actually spend on items of support. Any money they save or invest or spend on things that aren't support items, it gets completely excluded from the total support calculation. And there's another massive factor that comes from the case of Turecamo v. Commissioner. The court decided that Medicare Part A benefits, the part that covers hospital stays, are not included in the total support calculation. And why is that? Because these payments have no direct economic impact on the financial relationship between the dependent and the taxpayer. This can dramatically lower that denominator, making it a whole lot easier for you to meet that 50% threshold. Now, a lot of the time, a taxpayer's biggest contribution isn't even cash, it's housing, and valuing this in-kind support is absolutely essential. The standard we have to use is fair rental value, or FRV. Now, this isn't what you pay on your mortgage. It's what you could reasonably charge a total stranger for the same lodging. And it's not just the room. It also includes a proportional share of utilities and other household expenses, which can really boost your side of the support equation. Okay, we have covered a ton of technical ground, so let's pull all of this together and synthesize it into a clear, actionable checklist you can use to deconstruct any dependency claim that involves a benefit recipient. And here it is. Step 1, quickly verify those 3 straightforward pillars: relationship, gross income, and not a qualifying child. Get those out of the way. Step 2, isolate the income streams. You got to correctly label Social Security as self-support and SSI as state support. Step 3, and this is the forensic accounting part. You calculate the total support by summing up everything that was actually spent from all sources, and make sure you value that lodging at its fair rental value. And finally, step 4, apply the formula. Divide what you provided by that total you just calculated. If that number is over 50%, you've met the test. And that brings us to our final thought for today. These rules, they were written for a different era. As our society changes with new kinds of government help and way more complex family living situations, it raises a really critical question. How will this incredibly detailed mathematical definition of support need to adapt to reflect our modern economic reality? It's something the law is absolutely going to have to confront sooner or later.